Credit cards. They're in nearly every wallet in America. Over 500 million of them in circulation. Banks spend billions convincing you to get one. But here's what they don't tell you in those flashy commercials. Credit cards have created more millionaires and destroyed more lives than almost any other financial tool. Same product, completely opposite outcomes. One person uses credit cards to earn thousands in rewards, build perfect credit, and never pay a cent in interest. Another person spirals into debt that takes decades to escape. What's the difference? It's not luck. It's not income. It's understanding. Today, we're going to understand credit cards completely, how they really work, how companies profit from you, and most importantly, how to make them work for you instead of against you. By the end of this episode, you'll know exactly whether credit cards are your friend or your enemy. Spoiler, they can be either. The choice is yours. Let's start with the ugly truth. The average credit card interest rate is over 20%. Some cards charge 25, even 30%. To put that in perspective, if you invested money and earned 20% annually, you'd be one of the greatest investors in history. When you carry a credit card balance, you're giving that return to the bank. And here's where it gets sinister. Credit card companies set minimum payments deliberately low, usually around 2% of your balance. It seems helpful. It's not. That low minimum payment is designed to keep you in debt as long as possible. Let me show you the math. A $5,000 balance at 20% interest, paying only the minimum, takes over 20 years to pay off. 20 years. And you pay over $5,000 in interest alone. That $5,000 shopping spree actually cost you $10,000. Credit cards also directly impact your credit score, which affects your ability to rent an apartment, get a mortgage, sometimes even get a job. Used correctly, credit cards build your score. Used poorly, they destroy it. There's no neutral. Every swipe is either helping or hurting. Your payment history is the biggest factor in your credit score. 35%. Every on-time payment is a building block. Every missed payment is a demolition ball that takes years to repair. Credit utilization is another 30% of your score. That's how much of your available credit you're using. Max out a card and your score tanks, even if you pay it off monthly. The system punishes you for using what you're given. Now, let's talk about rewards, cashback, travel points, sign-up bonuses worth hundreds of dollars. Credit card companies give away billions in rewards each year. Why would they do that? Because they make even more money from you in return. Studies show that people spend 12 to 18% more when using credit cards compared to cash. The rewards are designed to encourage spending, and they work. That 2% cashback means nothing if you're spending 15% more to get it. Premium cards with big rewards often come with annual fees, $300, $500, sometimes $700 per year. The math only works if you spend enough to offset the fee. Most people don't. They pay for rewards they never fully earn. Sign-up bonuses are the bait. Spend $4,000 in 3 months, get $800 back. Sounds amazing, but you have to spend $4,000, money you might not have otherwise spent. They're betting you'll overspend to hit the bonus, then carry a balance, and they usually win that bet. There's actual neuroscience behind this. When you pay with cash, your brain registers pain. The pain of parting with something tangible. When you swipe a card, that pain is dramatically reduced. You're not really paying. You're just promising to pay later, and later feels free. MIT researchers found that people are willing to pay up to twice as much for the same item when using credit instead of cash. The payment method literally changes how you value things. Credit cards aren't just a payment tool, they're a psychological manipulation device. Let me show you where the money goes. Credit card companies made over $100 billion in interest charges last year, another $50 billion in fees, late fees, over-limit fees, annual fees. This is their business model. They profit when you struggle. When someone offers you something valuable for free, you're not the customer. You're the product. Credit card companies are offering you convenience and rewards. In exchange, they're buying access to your wallet and your psychology. The question is, who's really winning? So are credit cards evil? No, they're tools. Powerful tools that can build or destroy depending on who's wielding them. In part 2, I'll show you exactly how to wield them correctly. The rules that let you earn rewards without paying interest. The strategies that build your credit score without risking debt. And the specific cards worth considering. Subscribe to Smart Money Basics so you don't miss part 2. Your relationship with credit cards is about to change. Welcome back. In part 1, we exposed the dark side of credit cards. Interest rates that would make loan sharks blush. Psychological tricks that make you spend more. A business model built on your debt. Now it's time to flip the script. Because here's the thing. The same tools designed to exploit you can be turned to your advantage. The people who understand credit cards don't fear them. They profit from them. Let me show you how. Rule number 1. Never carry a balance. Ever. Charge only what you can pay in full when the statement comes. This single rule eliminates 90% of credit card danger. Pay in full and interest rates don't matter. 20%, 30%, it's irrelevant. You never pay it. Rule number 2. Set up auto pay for the full balance. Not the minimum. The full balance. This removes human error and procrastination from the equation. Your bill gets paid in full, automatically, every month. Set it and forget it. Rule number 3. Keep your utilization low. Use less than 30% of your available credit, ideally under 10%. If you have a $10,000 limit, try to never have more than $1,000 on the card at any time, even if you pay it off. High utilization hurts your score. One trick: spread spending across multiple cards to keep utilization low on each. Or pay your balance before the statement closes. Utilization is measured when your statement generates, not when you pay. Rule number 4. Check your statements every month, line by line. This catches fraud, unauthorized charges, and keeps you aware of exactly where your money goes. Awareness is the enemy of overspending. Now let's talk about the real benefits. Credit cards offer fraud protection that debit cards can't match. If someone steals your card number, you're not liable for unauthorized charges. With a debit card, that money is gone from your account while you dispute it. Credit cards give you a buffer. Many cards include purchase protection. Buy something and it breaks or gets stolen within 90 days, the card covers it. Extended warranties? Free. Some cards double manufacturer warranties automatically. These benefits are real, and they cost you nothing if you follow rule number 1. Premium cards often include travel insurance, rental car coverage, airport lounge access, TSA pre-check credits. A single covered rental car incident could save you thousands. The key is using these benefits intentionally, not as an excuse for the annual fee. Your credit history length matters. 15% of your score. That old card you got in college? Keep it open, even if you don't use it. Put a small recurring charge on it. Set up auto pay and let it age. Closing old cards shortens your history and hurts your score. Here's a mindset shift. Think of credit cards as an emergency tool, not a spending tool. The credit is there if you need it, but you don't need it for everyday purchases. That's what your budget and debit card are for. Break glass in case of emergency. Otherwise, the glass stays intact. If you follow the golden rules, you can play the rewards game, and it can be worth thousands of dollars per year. The strategy: use the right card for each spending category. Groceries on the card that gives 4% back on supermarkets. Gas on the card that gives 3% at gas stations. Travel on the card that earns double points on airlines. Match your spending to your cards. This takes 5 minutes to set up and runs on autopilot. If you already have credit card debt, a balance transfer can help. Many cards offer 0% interest for 12 to 18 months on transferred balances. This gives you breathing room to pay down the debt without interest eating your payments. But watch the balance transfer fee, usually 3 to 5%. On $10,000 of debt, that's $300 to $500 upfront. Make sure the interest savings exceed the fee. And don't use this as permission to rack up new debt on the old card. Finally, simplicity wins. You don't need 10 cards. 2 or 3 optimized for your spending patterns is plenty. More cards mean more to track, more fraud risk, more temptation. Cut the ones you don't need. Simplify. Let me give you the complete credit card playbook. 1. Pay in full every month, no exceptions. 2. Set up auto pay for the full balance. 3. Keep utilization under 30%. 4. Check statements monthly. 5. Use rewards strategically, but don't overspend to earn them. 6. Keep old accounts open for credit history. 7. Simplify to 2 or 3 cards maximum. Credit cards are not your friend or your enemy. They're a tool. Like any tool, they can build or destroy depending on who's using them. You now have the knowledge to use them correctly. The choice is yours. Next episode, we're tackling something everyone needs, but few have. The emergency fund. How much you really need, where to keep it, and how to build one fast. Subscribe to Smart Money Basics